Opening statements today will be limited to 15 minutes for each side. Without objection, all members' opening statements will be made part of the record. We meet today to continue the review by Capital Markets Subcommittee of Insurance Regulation. Our panel has taken the lead in Congress during the last few years in debating insurance matters and finding consensus reforms to modernize our national insurance laws. Unlike other financial sectors that have evolved over time to include some degree of federal and state regulation, states alone continue to have the primary authority to regulate insurance today. For that reason, Congress has historically only passed insurance legislation to respond to a crisis, address a market failure, or adopt narrowly focused insurance reforms. For example, after September 11th, Congress ultimately passed the Terrorism Risk Insurance Act so that construction could continue after the terrorist attack and businesses could obtain coverage to protect their viability. After a series of hearings debating the insurance reform last Congress, this committee considered and approved 4 narrow insurance bills. One of those bills, the Insurance Information Act, could help the federal government build a knowledge base on insurance matters so that the federal government could see the complete picture of insurance industry rather than intermittently seeing the brushstrokes of a particular problem in the industry or at a particular company. We are very fortunate that this committee has a long history of working in a bipartisan fashion. I hope we continue in that vein and find common ground on these matters. Throughout, broadly supported legislative reforms are usually the most successful. We must, however, also move swiftly, yet deliberately, in developing a new game plan to involve the federal government in more direct oversight of the insurance industry. Today, we are both responding to a crisis of sizable proportions and seeing the big picture of an interconnected, modern financial services system for the first time. After the turmoil in the bond insurance marketplace, the decisions to provide substantial taxpayer support to American International Group and the requests of numerous insurers to get capital investments from the Treasury, we can no longer continue to ask the question about whether the federal government should oversee insurance. The answer here is clearly yes. The events of the last year have made and have demonstrated that insurance is an important part of our financial markets. The federal government, therefore, should have a role in regulating the industry. As such, we now must ask how the federal government should oversee insurance going forward. This question is the topic of today's hearing. The answer to this question is difficult. The bond insurance crisis showed that even small segments of the industry can have a large economic impact. AIG taught us that the business of insurance has become complex and no longer always fits nicely into the state regulatory box. Moreover, some companies operate unlike traditional insurers in today's markets. Instead of insuring assets, these companies insure financial transactions and use substantial leverage. My assessments should not be taken as criticism of the present state regulatory system. By and large, state regulators have performed well, despite the growing complexity of the financial services system. That said, I am also not suggesting that we expand the mission of state insurance departments beyond insurance. At the very least, this Congress must address insurance activities as it creates a new legislative regime to monitor systemic risks and unwind failing non-depository institutions. The administration's proposal to create a resolution authority properly includes insurance holding companies. Oversight of any financial activity, insurance or otherwise, as it relates to the safety and soundness of our economic system must also be mandatory. Insurance is complex, and it is time for the federal government to appreciate its importance. Equally important to me is that Congress not limit itself to simply responding to this latest crisis. Many insurance products are either of national importance or uniform in nature. We must therefore consider whether to regulate these elements of the industry nationally. In sum, we have asked our witnesses to help us to examine these issues. Their fresh perspectives can point us in the right direction as we think about these matters in a new light. I'd I'd like to recognize the ranking member, Mr. Garrett, for 5 minutes for his opening statement.
Thank you, Mr. Chairman, and I look forward to an interesting discussion today on the appropriate role of the federal government to regulate insurance going forward, particularly in the context of proposals for risk regulators and resolutionary authority for these large non-bank financial institutions. You know, if I have outlined in my previous hearings, I have concerns with some of these proposals and the likely unintended consequences if they are to be implemented. As for a systemic risk regulator, we have been told throughout history that more regulation will solve our problems. You know, the Federal Reserve itself was created to ensure that these asset bubbles and panics would never happen again. It was back in 1914 that the then controller of currency had high expectations when speaking about the law that created the Fed. He said, "Under the operation of this law, such financial and commercial crises or panics that the country experienced in 1873 and 1893 and 1907 seemed to be mathematically impossible." Clearly, he was mistaken, and he's had a lot of company since then. A certain level of regulation is appropriate, but many of the reforms being talked about now will reduce market discipline and increase moral hazard. With the resolution authority being proposed by the Secretary Geithner and others, for instance, I have real doubts that this can be implemented without institutionalizing an entire segment of too big to fail companies. So I have concerns in general about systemic risk regulation and resolution authority, but what they seem particularly inappropriate for the insurance industry. See, insurance companies, especially those dealing primarily with retail customers, are different in nature from banks, for example. They are not nearly as interconnected with the rest of the financial service sector and the economy as a whole. Additionally, we already have the state guarantee funds to deal with insolvent insurance companies. And quite frankly, these funds have historically worked very well. Bond insurance, as you mentioned, of course, is a bit of an outlier here, and the committee, I think, will address some of the unique challenges facing that sector on a different track. I also have concerns in this current environment and with the makeup of the present administration and the congressional leadership with proposals calling for significant regulatory changes. To supporters of these proposals, I would say, be very careful what you wish for. And when you think about it, it's not too far stretched to see a tri-layered or even a quadruple-layered regulatory structure for insurance when all the dust settles. You could have state regulation, federal regulation, systemic risk regulation, and resolution authority regulation on top of that. So while the topic of federal versus state regulation of insurance fosters intense debate, I believe we all can agree that a multi-layered regulatory structure for the insurance industry would not provide the best model for a competitive and a robust marketplace. Finally, on one other piece, the regulatory puzzle, I've been working with Congressman Dennis Moore, and we've been directly involved in the Non-Admitted and Reinsurance Reform Act. As you may know, this is a piece of legislation that passed the House overwhelmingly in past two Congresses. And what it would do is update and streamline state regulation in the non-admitted or surplus lines and reinsurance market. So the surplus lines bill is an area of insurance regulatory reform where there is broad consensus, and I look forward to working with my colleagues on the other side of the aisle to make sure that we get that piece of legislation done during this term of Congress. And with that, I yield back.
Thank you very much, Mr. Garrett. Now recognize the gentleman from California, Mr. Sherman, for 2 minutes.
Thank you, Mr. Chairman. When we first started talking about a federal role in insurance, we were dealing with the problem that certain life and annuity products were being approved too slowly through the multi-state regulatory process. And I dream of those old days when the biggest issue facing this subcommittee might be that consumers were being denied creative annuity products on a timely basis. Such problems seem almost quaint. But we should try to achieve faster approval of new products through the multi-state process or through some federal involvement. But we should recognize that traditional insurance was well regulated, and while all the other houses on the block blew down, the state-regulated insurance policies and annuity contracts are still standing. In analyzing this issue, we have to ask, what is insurance? The President today has talked about an open, transparent market for derivatives. I think we have to look at many of these derivatives, particularly credit default swaps, as insurance, and we don't allow people to sell insurance without regulation and without reserves. And finally, I think, Mr. Chairman, we have to avoid an issue of forum shopping, where we create a circumstance where you get to pick your regulator. Not only will some insurance companies pick the easiest regulator, but you will also see what we've saw to some extent among bank regulators, competition to be the friendliest regulator. Now, I'm all for friendliness, but that should not be the basis on which regulators are selected and evaluated. I yield back.
Thank you, Mr. Sherman. Now we'll recognize the gentleman from California, Mr. Royce, for 3 minutes, but also Mr. Royce is the author with Ms. Bean of one of the important pieces of legislation pending before the committee. So maybe we can get some insight into that bill as we have this hearing today. Mr. Royce, 3 minutes.
Thank you, Chairman. Thank you for your continued leadership on this and the hearings that you held last year and now on this issue of insurance regulation. I think that a consensus was formed that modernization of our regulatory structure was necessary, and I think part of that consensus is that there's a federal role here in insurance. I think the events of last year really changed the debate on insurance regulatory reform. I think prior to last year, the regulatory structure of 50-plus separate regulators, that was criticized as being inefficient, as being duplicative, as being anti-competitive, certainly costly for consumers. But in early 2008, we had another issue surface, and we saw many of the top bond insurers suffered significant losses and subsequent rating downgrades resulting from their exposure to the U.S. mortgage market. Their rating downgrades contributed to the freezing of credit markets, and that fed, of course, into the larger economic crisis and turmoil that we've had in this country. And then came the fall of AIG, and the bets that brought down AIG were made through the firm's securities lending division, as well as the financial products unit. As we consider the events of the past as they pertain to regulatory reform, it's worth noting that the securities lending division was facilitated and funded by AIG's insurance subsidiaries as a vehicle to make unwise bets on the U.S. housing market. At least that's the way I'd put it, since they were leveraged 170 to 1. Using capital from their insurance subsidiaries, with the approval of the various state insurance regulators, the securities lending division, in tandem with the financial products unit, put at risk the entire company and, to some degree, the broader financial system. The AIG debacle has also reminded us of exactly how global in scope the insurance market really is. AIG had subsidiaries operating in 130 countries and jurisdictions. The now notorious financial products unit had a significant presence in London. In order to adequately understand the threats within our own financial system, our regulators must be able to look at the entire picture, which often means relying upon, to a certain extent, upon equivalent regulators overseas. The European Union continues to move closer to phasing the Solvency II directive in, and that is probably going to pass this year. Solvency II will create one market for insurance throughout all of Europe, while we have 50-plus separate markets here in the U.S. Another aspect of Solvency II is meant to increase the global cooperation effort by bringing equivalent regulators from around the world into closer consultation with each other. Now, unfortunately, we have not held up our end of the bargain. The various state insurance regulators simply do not have the authority to negotiate with foreign regulatory bodies on behalf of the U.S. market, and as a result of our fragmented state-based system, we will not have that regulatory presence capable of understanding risks from around the globe. I have co-authored the National Insurance Consumer Protection Act with Representative Melissa Bean to establish a federal insurance regulator that would have the capacity and the legal authority to address these issues and the many others that have surfaced over the years. And in closing, I believe any regulatory reform effort will be incomplete without the inclusion of a world-class federal insurance regulator. And I look forward to hearing from our panel of witnesses on this topic. And again, I thank you, Mr. Chairman, for your leadership on this issue.
Thank you very much, Mr. Royce. And now we'll hear from the gentleman from Georgia, Mr. Scott, for 2 minutes.
Thank you very much, Mr. Chairman, and I want to congratulate you and the ranking member for holding this very important hearing regarding insurance regulation reform. I think it's very important that as we move forward, that we realize and learn from the experiences we've just gone through, especially with AIG, as we move forward to deal with this issue. Most experts would agree that the problems with AIG stem from their excessive trading in credit default swaps out of their financial products unit in both London and in Connecticut. That was not regulated by the state commissioners, but was regulated at the federal level with the Federal Office of Thrift Supervision. And also, the majority of insurance companies are indeed solvent. They are functioning well. So the fundamental question as we go forward is this: does this not only suggest that a radical overhaul of the insurance regulation at the federal level might not only be unnecessary, but it could also be potentially dangerous? I think it's very important that we take into account as we move forward the actual operations of these businesses, take into account the complexities of them, the areas in which they must be free to compete. We have to make sure we understand how to ensure that whatever actions we take, that it does not deter competition, that it does not lessen efficiency or increase costs of operating, from the development of global markets to the various and detailed policy rationales toward pursuing regulatory reform. We must take all of these into account. We must listen to both sides of the issue before taking further action. This is an extraordinary important facet of our financial regulatory reforms. I will soon be introducing or reintroducing legislation which is called the National Association of Registered Agents, Brokers, and Reform Act, or NARAB, which I believe is a start to reforming one part of the insurance industry and ensuring adequate agent and broker licensing, which is extraordinarily important. The legislation is straightforward. Insurance agents and brokers who are licensed in good standing in their home states can apply for membership in NARAB, which will allow them to operate in multiple states. Last Congress, this bill garnered 52 bipartisan Democratic and Republican co-sponsors. And I believe that with continued strong support and interest, this provision will be included in our insurance regulatory reform package as we move forward. Again, I congratulate you, Mr. Chairman, and our ranking member, and I look forward to the testimony of our distinguished visitors.
Thank you very much, Mr. Scott. We'll now hear from the gentlelady from Illinois, Ms. Biggert. 3 minutes.
Thank you, Mr. Chairman, and I'd like to thank you and the ranking member, Garrett, for holding today's hearings. It's important that insurance be a part of the conversation at the federal level on how to monitor institutions that could pose a systemic risk to the financial system. Should an insurance representative be a part of a federal systemic risk council? Who would that representative be? Should Treasury have an Office of Insurance Information? What regulator could or should unwind or dismantle a failed company like AIG? Whatever the solution, I'm interested in hearing from today's witnesses about how insurance regulators and the insurance industry will have a voice at the federal level without dismantling the state insurance regulatory structure, a structure that has not failed. Notwithstanding AIG, the U.S. insurance industry is alive and well, and state regulators, especially in my home state of Illinois, are doing a good job. In recent memory, the industry has survived terrorist attacks, the 2005 Gulf Coast hurricanes, and many other disasters that caused significant harm to our country and citizens. We as federal lawmakers should be careful not to throw out a regulatory system that seems to be functioning properly as we consider broader proposals to establish a federal systemic risk overseer. With that, I thank you and yield back.
Thank you very much, Ms. Baker. And now we'll hear from the gentlelady from Illinois, who's a co-author with Mr. Royce of the pending piece of legislation before the full committee. Gentlelady, Mrs. Bean, 3 minutes.
Thank you, Mr. Chairman and Ranking Member Garrett, for today's hearing and for yielding me time. The topic of today's hearing, how the federal government should oversee insurance, is a subject that Congressman Royce and I have worked on tirelessly for years to address the lack of federal regulatory authority over the insurance industry. Our predominant focus has been on increasing consumer choice and protections, providing advantages to agents, and improving industry efficiency. Consumers tell us that they want product and pricing options, innovative new products available to them, the benefits of market pricing, consistency of products across state lines, and the peace of mind that knowing that they can preserve the trusted relationships with the agents that they've worked with, even if they do move their families or their businesses, whether they be military, seniors, families, students, or small businesses. Agents are frustrated with the need to spend hours learning and training duplicative rules and regulations across state lines. Nationwide licensing provided in our legislation would allow them to eliminate that. They won't have to fight too hard to keep and grow their customer base or have the unnecessary costs of those duplicative training efforts. And the $8 to $13 billion that the industry spends across those multiple bureaucracies would be saved and could be passed on to consumers in savings. Since we started working on this issue, much has changed in our system. After committing nearly $200 billion of taxpayer dollars to AIG, with more money expected to be granted to several other insurance companies, the need for federal regulatory oversight has never been greater. In April, Congressman Royce and I introduced H.R. 1880, the National Insurance Consumer Protection Act, to create a national insurance regulator with the resources and authority to regulate insurance companies whose breadth and complexity far exceed the capabilities of the state-based system. H.R. 1880 is very different from past bills to create a national insurance regulator. This bill includes best-in-class nationwide investor and consumer protections exceeding the scope and resources of the current state system and any federal legislation previously introduced on the subject. It establishes a national insurance commissioner to regulate national insurance companies, reinsurance, property and casualty, and life insurance, agencies, agents, and brokers, similarly as the Comptroller of the Currency regulates national banks. It will not only monitor insurance subsidiaries, but also the activities of the holding company and non-insurance affiliates, such as AIG's well-known financial products unit. Unlike national bank regulation, this bill includes strong protections against regulatory arbitrage by prohibiting nationally chartered insurers from switching to a state charter without the approval from the National Insurance Commissioner. Unlike past legislation, our bill deals with systemic risk. It recognizes that Congress will create a systemic risk regulator which will subject all insurance companies, national or state chartered, to a systemic risk review. In instances when an insurance company is deemed to be systemically significant, the systemic risk regulator and the National Insurance Commissioner can require an insurer to be regulated at the federal level. The robust consumer protections of this bill provide best-in-class, uniform national consumer protections starting with the model market conduct laws of the NAIC and localizes the Office of National Insurance by requiring each state to have a physical office of their Division of Consumer Affairs. H.R. 1880 was recently introduced and intended to serve as a new starting point for the discussion of national insurance regulation. I believe the subcommittee should move a comprehensive bill that establishes federal regulation of all lines of insurance, property and casualty, reinsurance, and life. Insurance rates should be actuarially sound and not subject to arbitrary rate caps. And we should include strong, uniform consumer protections. I look forward to working with the chair, our ranking member, and my colleagues towards that end, and I yield back.
Thank you very much, Ms. Bain. Now we'll hear from the gentleman from Texas, Mr. Henserling, for 3 minutes.
Thank you, Mr. Chairman. Knowing that votes are on, I'll attempt to be brief here. Clearly, the issue that has been before this committee for some time, optional federal charter, I've listened closely to the arguments. Frankly, I think it is appealing on a number of different fronts. I think potentially it has the ability to make our markets more competitive. I think it could provide consumers with more choices at reduced cost. Having said that, I haven't quite signed on to the final product because I think there are some downsides as well. Clearly, there is a gap in expertise in insurance in Washington, D.C. We know that on March 18th, at a full committee hearing on AIG, that the head of the OTS in open hearing told us that they had the resources, they had the power, they had the authority, they had the expertise to prevent the debacle that became AIG. They just missed it. They just didn't do it, which is a lesson to all of us that, again, federal regulation is not necessarily a panacea. It would be interesting to know also exactly how this would intersect with the administration's intent to give some type of resolution authority to some federal body for large insurance companies. Many of us fear that this become a self-fulfilling prophecy to designate in certain firms as systemically risky and create all kinds of little Fannie and Freddies, or perhaps a better way of phrasing it might be large Fannie and Freddies throughout our economy, ticking fiscal time bombs for the American taxpayer. So clearly, federal regulation has not proven to be a panacea. Witness Fannie and Freddie and Wachovia and WAMU and the problems at Citi and Bank of America, and we've already mentioned AIG. So I believe that at the end, Mr. Chairman, we need to clearly move to smarter regulation, which is not necessarily more regulation. We need to figure out some way to end the too big to fail phenomena. And our goal should be to ensure that taxpayers have market competition, market discipline, and ensure that they are ultimately protected. With that, I yield back the balance of my time.
Thank you very much, Mr. Hanson. We'll now hear from the gentlelady from California, Spears, for 2 minutes.
Thank you, Mr. Chairman and Ranking Member Garrett. The subject of today's hearing is how should the federal government regulate insurance? I think at first, we really need to answer the question, should the federal government regulate insurance? Here in Washington, the common perception seems to be that federal regulation is always preferable to state regulation. In this case, however, I believe the move towards replacing state regulatory authority with federal, particularly if it creates a dual optional federal structure, it is seriously misplaced and misguided. AIG, the world's largest insurance company, is often cited as the poster child for the need for federal regulation of insurance. The case of AIG proves just the opposite. AIG's insurance operations and the fact that they were regulated by the states and required to hold risk-based reserves is the only reason AIG was salvageable, even if it took $150 billion in taxpayer money to bail out the federally regulated holding company. If the state regulators hadn't prevented the holding company from raiding state-based reserves, even the insurance subsidiaries would have gone down, jeopardizing consumers and state guarantee funds all across our country. In my opinion, AIG makes the argument not for federal regulation of insurance, but for the reintroduction of Glass-Steagall. In the words of AIG CEO Liddy before this committee and just yesterday before the Government Oversight Committee, AIG needs to return to doing what it does best, insurance. If it had stuck to insurance and hadn't been able to buy a small savings and loan so that it could choose OTS as its regulator, we likely wouldn't be facing the crisis we are facing today. Instead, it launched into the high-risk and supposedly high reward world of derivatives where federal regulators were largely asleep at the switch. OTS has admitted to this committee that they really had no idea what was going on. I think we can all agree that the regulator shopping among financial institutions has been a disaster, and we should not now be considering giving that opportunity to insurance companies. The insurance industry chafes under state regulation not because of the onerous regulatory burden, but because states impose stringent capital reserve requirements, and because of the ability in some states, like California, to pass tough consumer protection laws and rate regulation. Let me be blunt. I think the discussion is all about life insurance companies being further able to leverage their positions. I served as chair of the California State Senate Banking, Finance, and Insurance Committee for 8 years. The insurance industry lobbyists were always looking to weaken consumer protections. I think one of their frequent refrains that they needed to be free of state restrictions so they could be able to speed creative and innovative products to market so that they could compete with Wall Street has been shown to be the fallacy that it was and is. Insurance is an essential part of our economy. It needs to be strong and robust. The protections for the consumers and taxpayers must be equally strong and robust. I yield back.
Thank you very much, Ms. Beard. Now we'll hear from Mr. Neugebauer for 3 minutes.
Well, thank you, Mr. Chairman and Ranking Member, for having this hearing. One of the problems of being kind of last in the queue here is a lot of things that I wanted to say have already been said, but I think one of the things as we go down this road of regulatory reform, one of the things we need to make sure is we understand what happened. I think there's always a rush when something unexpected happens or something bad happens that somehow they blow the whistle and ask the government to come in and fix it. And quite honestly, the record of government and fixing things is not all that good. And so as we go down this road, I think we need to make sure we understand what happened. Where were the holes in the system? And in some cases, I think we're going to find that it's not necessarily we need more regulation, is we need better regulators, or regulators that are actually doing their jobs. And so what we don't need to do is to try to pass a bunch of regulation because regulators weren't necessarily doing their jobs. When it comes to the insurance industry, for example, AIG was a little bit different vehicle or entity than a typical insurance company. And so is there a need to separate the activities of some of these organizations? I think what we're going to find in our large banks and we're going to find in our larger institutions that got into trouble is that the regulators that were primarily responsible for them were looking at a core set of their business instead of some of the unrelated businesses that those entities were in. And maybe those regulators didn't actually understand those businesses that they're in. And so maybe a more appropriate regulatory structure is to make sure that you have regulators that have the expertise within the organization to make sure that they're analyzing all of the risks that are being taken. Particularly when we look at some of our life insurance companies and our insurance companies that are state regulated, as several of my colleagues have said before, is we don't want to be throwing another blanket over it. In other words, if the other blankets failed, then I think the larger question there is what happened and why didn't those regulators able to ascertain what happened to those entities rather than adding another layer. There are some that are calling for quick regulatory reform to do this very quickly. I think the more important thing is to do it right and to do it smart. And so I would hope as we go down this road, Mr. Chairman, that we take a role of first doing what people do in the medical community. Somebody gets sick or something happens unexpectedly and they die, they do an autopsy. I think what's in order here is a major autopsy of the areas where we had fallacies and failures, determine what happened, and then look at what the appropriate steps are going to be necessary to keep those from happening again. But I think the underlying thing that the American people and investors and everybody needs to understand, the federal government cannot keep bad things from always happening. People take risks and they look like a reasonable risk at the time, but not every business plan and not every business investment pans out like it is purported to do. And to think that regulation will fix that, I think sends a poor signal not only to the investors, to policyholders, but to everyone else, is that the government is not responsible for making things go up and down. It's responsible to make sure that there's integrity and transparency in the marketplace and in the regulatory scheme of making sure that people are following generally good business practices. With that, I yield back.
Thank you very much, Mr. Neubauer. As everyone is aware, we have a series of votes on. We've estimated it to be at least an hour and 10 minutes. So the committee will stand at recess for at least an hour and 10 minutes, and then we'll return immediately after the last vote.